Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy. We got some monthly review of some weekly ETFs. Kind of a new process we're going to do here is we're going to go back through, since we're getting closer to the end of the year. We're going to do a review on all of the different weekly funds that we have in our portfolio and what suggestions and requests comes from the comments. So the first one we're doing is WPay. The WPay is the weekly pay from Roundhill, the Universal ETF. We're going to give you the updates, the changes, the performance over the past weeks, and see if this is something that may add to your portfolio. But before we do, we got to do a big shout out to all of our Patreon suppliers and all of our YouTube channel subscribers. Without you guys, we couldn't keep the channel rolling. So we thank you. And if you're not a member, don't be afraid. Hit that subscribe button, hit that bell notification. And also, if you want, sign up for the Patreon. It's free. There's a lot of information on that side. You get videos a little bit sooner than you do on YouTube, but you also get that all for free. And if you want to support the channel, it's the best way doing it. So let's get into today's video. Notice to all viewers, past performance does not guarantee future results. The information in this video is for educational and entertainment purposes only. If you need financial advice, always contact a financial advisor or professional before making those financial decisions. I am not a financial advisor. So let's talk about the fund. The WPay Weekly Pay Universal ETF from Roundhill, the ticker is WPay. They have assets under management now of $539 million. Their expense ratio is 0.99%. They have 10.82 million shares outstanding already. And this fund only started in September 4th of 2025. So realistically, we're just, 3 months into this, 2 months into this. Distribution rate, 59.71% per Roundhill. The holdings. This is what's unique about WPay. What they did, Roundhill took every one of their weekly pay ETFs and put them all together in what we call a fund of funds. Everything is put together. The weighting is about equal across the board. They try to keep that in about that 6.5% to 7% range. So when one fund goes dramatically up over a certain period of time, they reset the entire portfolio. So you never have a massive unbalanced approach. Everything is well balanced. So it rebalances once a month with all of the weekly pay ETFs. So ultimately, what you could do is buy one share of this, and you're getting every one of the weekly Roundhill funds that you're involved into now. So let's do a what if forecast, and that is a short-term forecast over the next 3 months. What if the forecast? What if tech and single stocks in the portfolio move up? Volatility is moderate and the ROC component stays stable. Then you'd be a moderately bullish scenario, which would put you at a 6 to 10% price to total return estimate increase. Distribution yield estimate would be a 2 to 3% over the next 3 months, which means the distributions have a potential of growing. That's in a moderate scenario. Now, what if the forecast, the flat to slightly positive stock movement, some distribution pressures, and ROC still stays the same? That's the base case. In base case, I personally look at base case over anything else. It gives us the most rounded perspective out there. So in this case, you'd have a 0 to 5% increase in the price of the total return estimate. You would see about a 1 to 2% growth in the distribution yield estimate. Now, if we go to the bear or volatility, which is what if the forecast, the pullback in major holdings, the high volatility, possible cut or heavy ROC distributions, you'd actually see a drop of up to 5% in the total return or price estimate. You would see a 0.5 to 1.5 over the next 3 months increase in the distribution yield estimate. The short track record basically means in the next 3 months, projections are highly uncertain. Okay. So there's really just nobody knows the future. No one knows what's actually going to happen. So these are all estimates. These are all guesses that are out there. But you got to be able to read through what they're saying and put it into your own perspective, put it into your own risk, do your own research on this stuff. Don't just take what something puts on a screen. Do your own research. I personally do my research and I look at this and say we have a -5 to a positive 10% growth based off of what if forecasts. So you go right in the middle at 0 to 5 is why you see I go to the base case. So let's look at the WPay. I call it an adjustable path. When you look at the track history that this thing has been on, in 1 month it's down 8.24%. 6 months down 0.37%, and year to date up 1.14%. Those numbers alone tell you volatility drives this fund. It drives the price of the underlying assets is what's driving the price of the fund. The 4-week moving average is $52.79. The current price that you see on the screen at $51.28 at the time of this video. So it tells you that it does have some room to climb to get just to the last 4 weeks moving average. The fund bounces between $50 and $56 for the price of the share. So there is a lot of volatility that goes up and down in the pricing. And if you're going to buy into a weekly paying fund, if you're going to buy into WPay, you have to understand you're going to be in a high volatility market. So let's take a look at the dividend announcements. They just announced today another 57-cent distribution. So that's not on the screen. That was just done about 15 minutes before doing the videoing of this. But overall, this gives it a dividend average now of 68 cents a week, which is nice for a fund in the pricing that it's coming into. You can look at the past dividends, what they have done, and calculate out, you will see a 68 cent a week distribution. So let's do the WPay return on investment. The new dividend came out at 57 cents, puts the average now at 68 cents per week. With the share price currently at $51.26, and remember that changes by minute, hour by hour. So if you took the 51.26, divided it by 68 cents, you would actually find out in 75.38 weeks, or 3/4 of a year, you'd have your initial investment back to you if the dividend average stays the same. And you can see that the new dividend at 57 cents versus the 68 cents, there is a gap between there. So I always estimate on a higher end, we put this at basically at 1 year. Now, based on current numbers, which can change daily, remember that you have to always pay attention. Now, Roundhill explicitly states that WPay distributions may include return of investor capital, along with ordinary dividends and capital gains. This structure can lead to erosion of the fund's NAV as those distributions are paid out. The statement indicates from Roundhill that the most recent disclosure, that 100% of the distributions for most of the recent periods reported, was estimated to be an ROC of 100%. This is a key tax and income risk point. You'll want to highlight the high line yield may look high, but the 100% of recent payout in ROC, the sustainability and after-tax return can differ meaningful from what may be expected. Where am I coming up with this? This is, you have to understand 100% ROC. This is used for tax purposes, for that tax and income risk point. But when you start watching the assets under management dropping, you mean that the fund could possibly be in trouble. So with the 100%, you always need to pay attention. If you look deeper into it, you will potentially find that the fund uses a 90 to 100% category across the board, making it great for tax purposes as long as the NAV does not drop off. So let's look at assets under management. In September of 2025, the fund came out 128.9 million. As of today, November 2025, they are now up to $539 million. So there's a big positive. That's almost $410 million in just 2 months of growth. So as long as we continue to see the growth in the WPay, or we see the assets continuing to grow or maintain, then we're pretty comfortable potential that this is going to be a solid fund. So I personally like this fund because of the assets under management. It continues to get bigger and bigger. I really like that. The return on investment, that 3/4 of a year to 1 year, very right into my ballpark. I like getting that back. I don't like that it was down 8.44% over the last 30 days, but I understand it. The volatility of the marketplace, the government shutdown would definitely put this into a questionable market, and I can understand why it's down. But the forecasting to me, using what I'm saying, that increase of 1 to 2% of the distribution yield, I like that side of it. I like that small little potential growth of the distributions, and I like the price evaluation from that 0 up to 10% potential increase. So overall, I like WPay. It's definitely a piece in my portfolio that I like to keep an eye on to, and I just think it's a strong piece. Tell me what you think.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.